Have you ever seen a product online with a price tag of, say, $100 and you notice that it's marked down to $37? That's an amazing deal. But what if I told you that was a trick? Or here's another example. If you go to a car dealership, there's a good chance they will show you a high-priced vehicle first. I'm picking on car dealerships for this example, but this applies to really anything. So then why do they do this? They know it's outside of your expected budget and that you probably won't buy the first vehicle that you look at. They do this to set the first piece of information into your mind. This is called price anchoring. Anchoring occurs when people rely too heavily on the first piece of information that they receive. This initial reference point changes how you feel about all of the information that comes afterward, even if the initial information is arbitrary. So then how does anchoring heuristics commonly show up in personal finance? The first example is price negotiations. Using the car dealership example, if the salesperson starts at $30K, knowing the car is only worth $22,000, you're more likely to pay more than $22,000 because suddenly $25,000 feels like a good deal, even though it really isn't. The initial price that they offered, the $30,000, anchored the discussion, and offering $22K would feel offensive to suggest. So how do you improve this? The first suggestion that I would have would be to do independent research to figure out what the fair market value of this actually is. Now, there are loads of tools online for whatever you're purchasing, and many people are great at this. However, it's really easy to not do your research up front, walk into a furniture store, and walk out having paid 20 or 30% more than what you should have. Now, the second suggestion is easier said than done, and that is be willing to walk away. Now, I understand some of these purchases are annoying, they're cumbersome, especially like buying a car. It's such a huge hassle that being willing to overpay just because you're exhausted is an easy trap to fall into. But there's a lot of power in being willing to walk away and go to someone who is willing to charge you fair market value for whatever it is that you're purchasing. It might take a little bit longer, but it's the best bang for your buck. The second way that this shows up is in investment decisions. So whenever we buy a stock, we have an initial price that we paid for, right? And this price can become an emotional anchor. Even though you paid a certain price for it, does not necessarily mean that the stock is worth that price. So if the stock goes down, people often resist selling because they're anchored to the purchase price that they paid. And they wait, even when it might be better to just cut their losses and move on to a winning investment. There are so many times that I've purchased an investment and it immediately went down in value. So how do you improve this? One suggestion that I have for mitigating this is to determine your price targets before you actually buy. If you believe that 2 years from now, something will be worth $100 and you can buy it for $70 today, even if it drops to $60, as long as nothing has materially changed with the company, then you are probably still okay holding on to it. However, if you don't set those price targets, if you don't know what the future value of a company could look like, then that's an easy trap to fall into and get wrecked. The second suggestion that I have for mitigating price anchoring with investments is to know what you own. Now, this phrase became popular by Peter Lynch, a famous investor, and I see so many people on this platform, on X, who are talking about stocks that they don't really understand. They don't understand the risks involved. They don't understand the price targets that they could reach. They don't understand the material growth trajectory of the business. All they see is that people online are saying, oh, this is going to 100x. And for some of them, maybe they could. However, there are so many people who purchase based on a suggestion from someone online, but they don't actually understand the fundamentals of the business. So then whenever there is huge volatility, meaning up or down swings in the price of the stock, people get scared because they don't really understand what it is that they own. They see that something is dramatically losing value. Maybe it drops 15, 20, 30% over the course of a few days. And those people, if they don't know what they own and don't have conviction in that investment, then they're more likely to panic sell. So that second suggestion is super important. Know what you own. Third suggestion for mitigating this with investments is to not doom scroll your accounts. If you constantly find yourself checking your accounts every day, every few hours, every couple of days even, it might be time to take a break. The more time that you spend looking at your accounts, doom scrolling on X or social media platforms, the more likelihood that you will fall into a sky is falling mentality. And sure, markets are very cyclical. There are bullish times and there are bearish times. There are times that we see dramatic increases in value and dramatic decreases. The point of this one is to zoom out. If we are all consumed by the markets, by current volatility or current macro trends, then that's an easy way to stress yourself out. That's why heavy research and awareness of what you own, understanding why you own it, what your price targets are, allow you to handle the volatility of the markets much more easily. For some people, they don't want the hassle and just want to invest in broader funds or stick with a few large assets. And that's okay too. Real quick, everybody, if you find this information interesting, I'd appreciate if you would subscribe and like the video. It really helps grow the channel and helps more people see this to be able to improve their own financial situation. All right, the third way that price anchoring shows up in personal finance is in salary negotiations. If you're currently making $50,000 and you're looking for a new job, you might anchor your expectations around that number, plus a small increase of, let's just call it $3,000. So even if the market rate for your skills is significantly higher, it's easy for our brains to think making 53 is better than what I'm making today, so I should just ask that. The problem is this can lead to undervaluing your own skills in negotiations and ultimately getting paid less than what you're worth. So here's how to improve this. A couple of resources that you can go to for this would be Glassdoor and Salary.com. Put your skill or your job title in there and your area that you work in, and it will offer some suggestions and ranges for what your salary should be. This third one is super powerful and it feels a little bit awkward, and that is rehearsing your salary request before you get into an interview. Now, this will feel weird. You're speaking to yourself or to your computer or looking at the mirror, however you want to practice. It doesn't really matter. What does matter is that having said the words out loud and formulated sentences multiple times before getting into that situation helps you whenever you're in a heightened stress environment and someone is asking what kind of salary are you looking for, then it's helpful to have said the sentence multiple times and be confident in being able to say those words and ask for what you feel like you deserve. So again, it feels weird. It's extremely powerful. Rehearse your request before interviewing. Be confident in the number based on the research that you've done, and the likelihood of making more money than what you previously would have asked for is actually really high. And the last thought on salary negotiations, there's a saying that you don't make what you're worth, you make what you ask for. And so do the research up front, know what you're worth, and then ask for that. So the fourth way that price anchoring heuristics show up in personal finance is in housing. If you haven't been living under a rock for the last 4 years, you know that housing prices have gone to the moon and interest rates along with them. Now, during the house hunt, you have to be careful because the first few houses that you see often become financial reference points for judging all subsequent properties, regardless of whether those initial prices reflect fair market value. Now, what this means is that the fifth house that you look at, let's just say that it's substantially cheaper than the first couple that you look at, does not necessarily mean that is better value. So here's how to improve on this. You have to be aware of hidden costs. Just because something looks reasonably priced does not mean that it actually is. Yes, that fifth house might be $20,000 less than the first couple that you were looking at, but what if it needs $40,000 of work in order for it to be comparable to the first two? Then ultimately the first two would be better value, even if it's more price per square foot than the fifth property that you were looking at. Now, it's important to look at hidden fees such as HOAs or other community expectations, like keeping up your lawn or having a certain quality of fence. All of these things can have financial implications in the long term. And I kid you not, there's a neighborhood that I know of that requires its residents to purchase hundreds of dollars worth of Halloween candy every year. That seems cool, but I don't know that I want to spend that every single year for Halloween. My last note on this is to look at many houses and consider all of the other costs that come with each house. And work with your realtor on this. They'll be able to talk through this with you and speak with the property inspector to make sure that you fully understand the implications, the priorities, the severity of some of the repairs that need to be made to ensure that you are comparing costs and getting a good value on the property. So just to quickly summarize, to counter price anchoring in financial decisions, you can research market values independently before making any kind of negotiations, whether that be for a salary or for a purchase. Consider multiple reference points online rather than fixating on a single number. Question your initial assumptions about what reasonable prices actually are. Make sure that you're doing the diligence, focus on fundamental value rather than arbitrary reference points, and seek out perspectives to challenge your anchored thinking, meaning talk with people who are experts in that field who can give you advice and tell you whether a price is crazy or not. But what do you think? How else does price anchoring affect our finances? Feel free to leave a comment or send me a message. I would love to hear from you. Otherwise, have a great week.